All right. I think we are live now. How's it going, everybody? Jordan here with Laundromat Resource. Super excited. Listen, I'm super excited to talk taxes. That is what I'm excited about. Laundromats, taxes, financial planning, wealth building. This is what this thing is all about. So hopefully you are also here and excited to talk about those things. I mean, listen, who's not excited to talk about taxes? I mean, come on. But seriously, this is all part of like that sort of wealth building thing. So I'm super duper excited about all of that. Always excited to hang out with all you guys. And welcome, Scott. How you doing, man?
I'm doing great, Jordan. Doing really good.
Awesome. Well, I'm excited to have you here. Appreciate you taking the time to come and share your expertise with us. Hard-earned expertise at that. If you guys are chiming in here as you're sort of trickling in, maybe chime in the chat there and let us know, where you're tuning in from. And feel free also, if you have any on the ready, to start throwing questions in the chat. My job is to sort of collect those questions and make sure that they get in the hands of the real expert here, who's Scott. So while you're letting us know where you're chiming in from and getting questions populated in the chat over there, Scott, why don't you give us a little bit of background on you?
Yeah, thanks, Jordan. Like I said, I've been doing taxes now about over 30 years now. I started in a small town in Idaho and had my own firm there for about 13 years. And then I wanted to be part of the Provision team and moved to Arizona back in '06. And I'm one of the partners here at Provision. We just pride ourselves as looking at taxes differently and being proactive at them and looking at them and planning for them versus being reaction. And so, like I said, Provision, just a little different attitude. Always want to try to see what we can do to save taxes during the year versus just having, when I file my return in April and my accountant says I either owe money or I get a refund, and that's not very proactive. That's reactive.
That's
So
right.
we just try to take a really proactive approach at it and try to save people taxes. There's a lot of ways to do it. And I enjoy talking about it. So it's fun to be here.
Yeah, well, and one of the reasons that I was excited to have you on the podcast and double excited that you were willing to come do this, because I am 100% on board with the proactive train here. And I think especially as, those of you guys who own laundromats already, and those of you guys who are looking to buy laundromats and or other businesses or real estate, those kinds of things, this is something that you should be thinking about, because there's a lot to be gained by being proactive when it comes to your tax planning strategy and your wealth building strategy. That doesn't just happen. You have to make it happen, right? And I'm always, talking to my family about this. Like, one of my principles is like, hey, listen, I don't want life to just happen to us. I want to make things happen in life. And obviously we can't control everything, but I want to make things happen. And that's similar with the wealth building and tax strategies and all that stuff too. So we're in sync.
Yeah, it's your biggest expense every year is your taxes. The
Yeah.
biggest thing, not your house payment, not those other things. It's your taxes you pay. And so we can do anything a little way to reduce that a little bit. There's always some savings you can take and way to add to your wealth. As you like I said, reduce your taxes. That means you build your wealth faster because you're not paying it all to the government.
Yeah, that's exactly right. We're gonna start jumping in here in a second. So get those questions in real quick. I want to hear how hot is it right now where you're at?
In Arizona?
Yeah.
I think it's 107.
Yeah. Okay.
It's actually cooler today.
Nice.
It's hard to believe.
Yeah, you're gonna go take a stroll here.
112, 113s earlier this week, so that's a little warm. So it's just after so it's in the afternoon time, so it's cooling off a little bit.
Yeah, I was gonna say maybe Trevor, who's in Santa Clarita, might be able to compete, but I don't know if it's 107 in Santa Clarita yet. I know it gets that hot there, but I don't know if it is now. But anyways, welcome to Trevor. Kurt from Atomic Laundry in Atlanta, Georgia. Welcome. Chris, my neighbor, Orange County, California. We're representing the OC over here. And Josh, welcome from Kansas City. And we'll get to some of these questions here too. Oh, Jay's in Moore Park. Awesome. Representing strong here. I'm going to put just real quick before we start jumping into these questions, I'm going to put a Scott mentioned Provision, which is where he is. Provision Wealth is where he works. So I'm just going to throw the link in the chat there, and I'll throw it on screen there just in case you want to check that out too. And I'll throw it in there again a little bit later too. But just in case you guys want to jump in. What's up, Waleed? Legend in the house. And I'm just going to take a quick opportunity before we jump into this Q&A. I know that's what we're here for, and I'm taking a long time, but I just want to just throw a quick plug to Waleed, who's putting on the event of the year in laundromats. That's coming up in August 7th through 9th. We got an email going out about it tomorrow. Waleed, it's going out tomorrow. Listen, the Laundry CEO Forum, laundryceo.com. Go check it out. You got to be there. You can't miss it. Waleed's put together a stellar lineup, and you're just going to want to be there. Okay, so that's in Frisco, Texas. So check out laundryceo.com and go register for that. Or you can wait till tomorrow when I send you the link. If you don't want to go type all that in, you can just click the button in the email tomorrow. But definitely go check that out. And huge shout out to Waleed for putting that event on. It is no small feat to put on an event of this magnitude. So go support him, but also, listen, let's mix it up over there in Frisco, Texas in a few weeks here. And Natalie, welcome in Toronto. Okay, cool. So let's jump into some questions. I'm gonna tackle this first one from Nikki's Nutsack. Thank you for chiming in the question here. I'll tackle this one though. Opening laundromat, or wanting to open a laundromat, one of the fastest growing cities in Florida. Need some guidance, franchise or fresh build. There's a couple laundromats there already, but they're not for sale. They're kind of run down. For me, I'm always going to favor a fresh build over a franchise. Because there's a lot of reasons for that. I've talked about that kind of over the time, but I don't see the bang for the buck in our specific industry when it comes to franchising there. There's some great franchises. If you want to look into that more, I highly recommend checking out Laundry Lab franchise. Those guys are buddies of mine over there, and I think they do it about as well as anybody does in the franchising. I just have a hard time recommending the franchise model because there's a big franchise fee up front. They take a cut kind of along the way off the top line, and that really cuts into your bottom line returns there. And this business is not that complicated, and it's not a brand recognizable. There's no McDonald's of laundromats, at least not right now. And so you're not going to benefit from that branding in the same way that you would maybe in another type of franchise. So for me, I'd go new build if you were considering between the two. But listen, there's also some strengths of franchising. Check out Laundry Lab if that's a direction that you're interested in going to. Okay, so Eric has a question for you, Scott. Let me take this off so that people can see your name there. Okay, so Eric says, in New Jersey, welcome, New Jersey. We got West Coast, East Coast, middle of the country, Canada. We're international over here. We got everything represented. That's awesome. Okay, so Eric says, any smart strategies for an individual leaving a W-2 and buying a store? And let's talk about that kind of from a financial perspective. In maybe it's tax, or maybe it's just kind of wealth planning or financial planning. Any things that you think that they should consider for that?
Well, obviously, you're making that big jump, and having that reserve and making sure you're covered financially. Things like insurance and different things that people don't really consider when you're leaving a W-2 job. You're going to go now be self-employed. Self-employed is a new brand of stuff, because you've got self-employment tax, and got filings that you never had to file before. So there is a lot of paperwork. So my best advice is work with a competent CPA and an attorney. Make sure you get your LLC set up, and you're making that jump, and working with the CPA to make sure, okay, have I covered all my bases when it comes to deductions, but also just financial stuff to make sure, because as with starting a new business, the first few months might be lean, and so you want to make sure you're prepared for that financially and be able to handle that. But like I said, a good CPA can guide you, walk you through a lot of those steps, whether it be entity setup, opening the right bank accounts, making sure you're putting money in the right spots, will be a vital help. That's probably the best advice. Just get a good team around you. That's the biggest thing. Those team members, I know it costs money, but that is money well spent if they save you the headache or problems down the road. And so a good team around you is going to be the best advice I can give you on that.
Yeah. I mean, I think that's great. And I'll kind of hit it from the other angle, just on, kind of, I guess, the laundromat side, but not really. I mean, I would say, do as much as you can before you leave that W-2 job, right? Like when you have a W-2 job, you have easier access to money. Banks like that. I'm going through a real estate acquisition right now and using, business income, and, it's a whole lot more complicated. Interest rates start getting a little higher sometimes. Sometimes there's just hoops you have to jump through when you're self-employed or you own your own business that you don't necessarily have to jump through when you have a W-2 job. So financing wise, do all of that stuff as much as you can while you have that W-2, if at all possible. And then once kind of everything, all the dust is settled, then leave that W-2 if that's the plan there. But there are advantages to having that W-2. I know there's like a huge train, and I'm kind of on it, on like, hey, leave the W-2 and go do your own thing. But there are benefits that you can leverage when you have a W-2 that either you can't when you own your own business, or that are more difficult to do when you own your own business.
That's really good advice, George. That's fabulous advice. Because you're right. You just, any kind of financing you're going to do with a bank or anything, they love W-2. That just looks better for them, and it's easier for them to handle. Self-employed, just you open a whole bunch of other bags and hoops you got to jump through. So that's good advice.
Yeah. And I think too, just having that W-2 as you're kind of going through the process also gives you sort of this sense of stability. I mean, unless your W-2 is like driving you insane,
Crazy.
which can happen. Well, that's why a lot of people want to leave their W-2 there. But having that steady source of income, especially as you're just getting started, could be good, depending on how you get in the business. And I'm going to take a quick pause. There's more questions here, and there's some really good ones. This next one, I think, is a really good one. But I want to take just 1 second just to say, on Scott's behalf, on my behalf, just on behalf of everybody, listen, this is a Q&A. We're trying to give some general knowledge and direction and insight. This is not personal, advice for anybody, not personal tax advice for anybody or financial advice for anybody. If you want that and you want it, what it takes is understanding a full understanding of your position, of your situation, of your goals, and of your where you're at in the process right now, right? So that's where Provision Wealth comes in. And if you want that, that's the service you want. But this is here to kind of give you some general advice, some general direction. And then when you're ready to really start locking this down, that's where you go talk to that CPA, go to provisionwealth.com and check that out there. I just wanted to say that sort of as a disclaimer of, we're not giving out personal advice because we don't understand all the nuances of everything.
Right.
But you can get that advice through going to Provision Wealth.
Right. Everyone's tax situation, financial situation is so different. So in here we talk about general terms about things, how they look, but like I said, each situation is so different. So we can provide general and some education stuff about different things, how to maybe do things. But again, Jordan, you're right on the money there. We're just trying to get you, and then if you need expert help, then you need to get the help you need, because they'll look at the whole picture, all the things that are going on. Here we're just taking, just tackling some questions here from an education basis. So good advice, Jordan.
Yeah, awesome.
Okay.
Like, man, what I love about you is that you're like, I feel like you're my hype man right now. You've told me good advice, good question, like twice now. I'm feeling good about myself right now. I don't know. Okay. So Jay has a question, which is a great question. And, the essence of the question is a stock sale versus an asset sale. I'm going to read it in a second, but as I read it, and then as Scott, as you answer it, Jay, I'm going to ask you, because one thing you said is that the seller is insisting on a stock sale. I want to ask you, if you can put it in the chat, do you have any idea of why they're insisting on a stock sale versus an asset sale, and what what their motivation is. But here's the question: process of purchasing my first laundromat right now. The seller's insisting on a stock sale as opposed to an asset sale. Wanted to get some input on this from a tax perspective. So maybe Scott, if you could first of all describe the differences. We talked about this on the podcast a little, but describe the differences just so we're all on the same page. Stock sale versus asset sale, and then maybe give some general guidance on this particular situation.
Perfect. So in a stock sale, it is just that you are buying the stock. So you are stepping into their shoes. So you take over their business. One day they own it, the next day you own it. I mean, you're just stepping into their shoes and taking over their business. So that is it is easy to do that. That's what many sellers like that, because for them it's very clean. I'm just selling my stock, it's done. An asset sale is where I'm going to go in and buy the assets or the equipment, the client list, whatever. I'm going to buy those items. And then at that point, then I have a new entity. I put those items in my new entity and I take depreciation. I take all those stuff I do because I purchased all that stuff. And if you understand, if I buy the stock, no extra depreciation. I don't get any bump up in depreciation. It's already done. That's already been done when they bought it, right? So usually a seller will like a stock sale because it's just easier for them. But the reality is, from a buyer standpoint, buying the stock is a challenge for me because, one, I don't get that depreciation of equipment and all that stuff. And two, I now own a stock in a company that I don't know what has happened in the past. Are there skeletons in the closet? Did they not file pay reports 10 years ago that now I've owned the stock, now I'm responsible for? So there's a lot of baggage that could come with buying that stock, and that's why it's a challenge for me. And I never usually recommend buying the stock when you're doing a deal like this, because that, one, the baggage that could come along, and two, I want those extra deductions. I want all that benefit, that depreciation. I want that when I buy a business like this. So I mean, there could be extenuating circumstances where it would make sense, but typically you want to do an asset sale if you can.
Yeah, and just to kind of piggyback on that a little bit, the stock sale, yeah, when you do that, right, talking about the depreciation, you'd have to find out kind of where they're at on the depreciation schedule. There may be some depreciation left, and you'd have to kind of untangle all that. But I think he was touching on the bigger issue, which is the liability issue, right?
Yeah.
They could have done, if they were paying people under the table and the IRS decides to come after you for that, they're going to come after you, not them, because you own the stock, you own the actual business. If there was a slip and fall before you took over and it comes out of the woodwork, which happens. So that happened to me one time. It was like 2 years after the fact, the guy came out and said he slipped and fell and sued me, right? So if that happens, you're liable for it because you own the stock. Whereas if it was an asset purchase, you're not liable for that. So, all this liability that comes up, in addition to losing out on, some of the other benefits like the depreciation, that's just a tough sale. But, to your point, and Jay said, I believe they want the stock sale because it gives them the tax advantage or the tax benefits. Scott, if you do a stock purchase, the seller doesn't have any depreciation recapture, right? Or do they?
Typically
How does that work?
Typically no depreciation recapture because they're just selling the stock.
But you're going to, if you sell an asset,
sell the assets, then they might have some recapture. So you're right. There may be some benefit to them to selling the stock because it may save them some taxes. But again, everything's negotiable, right? So the idea is saying, hey, I understand maybe there's some extra tax on your behalf, but the liability issue that you brought up, I mean, that's such a big challenge for me to get past that I just have a hard time, even if we could work out I know I've seen contracts where people say that, well, I have a contract that says that I'll maintain liability and I'll cover it if something happens after the fact. Yeah, it's just a lot of extra liability that you don't want to take on. So, like I said, I would always typically recommend an asset sale or a purchase when you're doing that. There's not a lot of good reason not to.
Let me put you in Jay's shoes for a second and me in the seller's shoes. Cause I'm just curious how you'd respond. You're trying to buy my laundromat from me and I say it's a stock sale or nothing.
Well, like I said, everything's for sale for the right price, right? So the idea that says, okay, hey, I want to buy your laundromat, and you say, okay, what am I willing to give up? Am I willing to pay a little more to get the asset sale? Which that may be incentive for him. Say, okay, yeah, I'll do an asset sale, but I want more money because now my taxes may be different. And I don't know the seller's tax situation, so I have no way of knowing that. But maybe that's what's causing them some concern. Say, okay, hey, can we increase the price? Can we do things to compensate other items in the contract to make it so that you get the asset sale you're looking for, and they maybe are made, they maybe get extra money to help cover some of those taxes. I mean, like I said, the idea is everything's negotiable, right? So you're trying to say, yeah, if he wants to sell, I mean, obviously, if it's a stock sale or nothing, I don't know that I would do that if there's no negotiation at all. But obviously, I think they're obviously looking to sell. I think you say, okay, what can we do to make this? So I want the asset. I want to do an asset purchase, and I know you don't want to do that, but can we sweeten the pot a little bit? Can we do different things to make it so the sell would be agreeable to it? That's what we'd have. You just have negotiated.
Yeah. And typically with any deal, right, as risk goes up, price comes down, right? Like that's typically how it's going to go. So if you're going to do a stock sale, that's a lot riskier both on the tax planning side of things, but also on the liability side of things, which means, that's a lever that you can pull in
Right.
negotiations, right? In that situation. Out
So
of
yeah,
curiosity,
in that case, you drop the price. Say, hey, you want to do a stock sale? Okay, you got to make it worth my while. I'm ready to do that because I'm losing out on a lot of tax benefits, absorbing maybe some liability. So therefore, the price would drop down. So yeah, either way, it's either up to get an asset or down if we get to stay a stock sale.
let's play the scenario just a little bit further down the road, right? So let's say that you buy my laundromat as a stock purchase, and then whatever, 5 years down the line or whatever, you decide to sell it, and you sell it as an asset sale, which would be normal
Right.
in this situation, right? Do you, and let's say in this scenario, I've depreciated all the machines already, so you get no depreciation. Do you, as the owner of that stock, have to pay the depreciation recapture on the sale?
Yes.
So that's going to be a financial
Yeah.
liability for
Because you're
you,
stepping
even though
into
you
their
didn't
shoes.
benefit.
Yeah, you're stepping into their shoes. So whatever they had, you now have that. So if they would have sold an asset and have recapture in 5 years, you would have the same thing. So whatever situation they're in, by buying the stock, you're just stepping into their shoes wherever they're at. So if they would have recapture, if they owned it and sold it in 5 years, you would have that as well. So yeah, there's a lot of down the road stuff that could come up that would maybe be, that you're not maybe thinking about ahead of time. So like recapture like that if you decide to sell later. Now, again, you're selling it at that point 5 years down the road. You know this recapture is going to be there. You've done some calculation. You know what the tax consequences are. You can say, okay, in order to get this done, I need to up the price a little bit to make sure that's worthwhile to cover my taxes, to make sure I'm covered. So you can make it work. But again, you're right. You're exactly right. You would have recapture because you're stepping right into their shoes by owning the stock.
Yeah, Jay. I mean, I think that that's a huge consideration for you, in this particular situation. And like Scott's saying, like there's probably still a deal to be made. Maybe,
Right.
potentially, and so it's worth further investigation. But it really, I mean, I get that they're trying to simplify it for themselves and get the benefit there, but it really muddies the water a lot in my mind. Both financially and liability wise, and that's why we typically do an asset sale and not a stock sale in these scenarios, because it actually makes things a lot more complicated there. So one thing for you, Jay, in particular, is make sure you're factoring into your calculations that depreciation recapture. Now, they may not have depreciated the machines fully, so you may still be able to benefit from that to an extent. That'd be a question that you'd want to ask. But any depreciation they have, they have used up to this point, you're likely going to be liable for that on the back end on the sale. And as of right now, for the past, I don't know, 6 or 8 years or whatever, you can't, do a 1031 exchange of a business to another business and defer that tax. You're going to have to pay that recapture there. So
Just to clarify, Jordan, on the recapture, basically what that is, when I take an asset and I expense it off, maybe with bonus depreciation, I write it off very quickly. The IRS has put some rules in place. And they call it depreciation recapture. Basically, it's just this: if I turn around and sell that asset, at some point, I've taken a deduction for this depreciation quicker than I normally would, and because I've done that, the IRS makes me pay a little. When I sell it, I have a little higher tax rate on that portion of that recapture, back up to my original cost. So that's why when we talk about depreciation recapture, it's not like you're picking up extra income or anything like that. It's just that recapture portion of your sale is going to be taxed at a different rate versus the long-term capital gains rate, which is that max rate of 20%, which everybody likes. So that's what when we talk about recapture, we're talking about, hey, I've depreciated this item quickly. Now I'm selling the asset. I need to recapture that deduction on that depreciation I took on that asset. And when I pay tax on that part of it, I have a higher tax rate. So that's what we're talking about here on depreciation recapture.
Yeah. Thank you. Thank you for clarifying that. I don't want to leave anybody kind of behind here. So I appreciate that. Okay. Chris has a question. Keep those questions coming, by the way. Awesome question, Jay. So keep those questions rolling in. Chris has a question. Can you be a W-2 employee at the laundromat and a co-owner?
The answer is, I want to make sure I understand your question, Chris. If you were a W-2 employee at the laundromat, then at that point you owned it as well. Depending on the type of entity you have, most often businesses, we would have an LLC tax and S corporation. In that case, if you work at that business and you own part of it, you're required to take a salary as a W-2. So that would not be an uncommon thing. But if that's, like I said, if you're taxed as an S corporation, again, an owner that works at a business that's an LLC taxed as an S corporation or a straight S corporation is required to take a reasonable salary. So not only can you'd be required to. Now, there are other entities out there, like if you were a C corporation, that would not have that requirement of the salary, or if you were a partnership, then at that point you can't, as an owner, you can't take a salary as an owner. So there's some special rules regarding that. So it kind of depends on what kind of entity you have in place there would determine that. But certainly you can be an employee of your laundromat and be an owner. That's certainly possible. And like I said, depending on the entity, it might even be required. Good question.
Yeah, super good question. One question I get a lot that's kind of piggy. What's up, Peter Mayberry? Yes, it's live. It's live right now. One question I get, kind of along those lines is, how do I know how much I have to pay myself if I'm an owner of a laundromat? You got any advice on that?
How much to pay yourself, you mean?
Yeah. Because you said a reasonable salary, and I know that that's what the language is. So
Yes.
how do I know? I mean, it's gray, right?
It's gray.
So how do I know?
It's tough. Usually there's a couple of things that we use to kind of determine reasonable salary. One, you can do research online, right? Find out, what is a person that does your job at a laundromat, what do they make? There's different websites, a lot of the employment websites out there will have a salary calculator. You can put in your zip code and what you're doing and what you do, and they'll kick out some kind of salary range. That's one way to do it. Oftentimes, though, we look at your net income and we say, okay, understand that some of my income is going to be as an owner because I'm wearing two hats. Some of my income as an employee. And so usually the easiest place to start is we do 50-50. So if I'm making $100,000 a year net income, that's revenue less expenses. Okay, 50% of that would be $50,000 would be a salary, $50,000 to be as an owner that I could take as well. So that's kind of a medium range, doing 50-50. Now, if I do some research online, maybe my salary needs to be $70,000 because of the research I've done online. So I take $70,000 and only $30,000 that I get as an owner. So a lot depends on your situation, where you're at. Locality can be big. I mean, obviously a salary in New York City versus a salary in Kansas is going to be different. Those localities are just different. The economics are different there. So doing some research online is probably the best. But like I said, usually we start at about 50% of net income and then go up or down depending on what we need to justify.
Yeah. That's awesome, because I mean, that question comes up all the time, is like, how do we
It's tough.
Yeah. Can you just real quick overview, like what are the implications of the different forms of taking money from your
Okay.
business, like
Yep.
salary versus, yeah, go ahead.
Yep. So let's talk about it. Now, obviously, it depends on the type of entity you have. But as an owner, you can typically always take money out of your company. What's an LLC, an S corporation, you take that money out as a distribution. Distributions, as weird as it sounds, are not taxable, right? That sounds crazy, but it's true. You pay tax on the net income of the business, whether you take it out or not. There's this misconception out there that, hey, I made a business, I made money, as long as I don't take it out of the company, I don't have to pay tax on it. That is not correct, right? So if you make money in your business, the net income, that's what you're going to have to pay tax on, that net income amount. If you take some of it out as a salary, you get a W-2 for part of it. Everything else that you don't take out as salary is going to be just income from your business, whether you file a Schedule C on your return on your personal 1040, or you file a partnership or an S corporation return, either one of those. But you pay tax on that net income, not the distribution amount. So because of that, you can take money out of your net income. You can take that money out as you're making money, take it out to live on. You can certainly take distributions as an owner. Owners get distributions, employees get salaries and wages. Okay, that's important to remember. So if you're working there, I'm going to get my wage as an employee, but I'm also going to get my owner, and what money I make as an owner, I can just take a check out of my company as a distribution for that. Right? That's key. That's where you get paid when you're self-employed and you own a business. You're going to take some of it out as a salary, some of it out as a distribution.
Yeah, perfect. That, I mean, I think that's going to help, a lot of people out, especially when you're first getting started. And, I remember like when I bought my first laundromat and they're like, okay, we got to put in like a, reasonable salary for you. And I'm like, well, I have like I have no idea. Like, I don't know.
Yeah.
I don't know any of that stuff, right? Like deer in the headlights, for sure. So I think that'll help a lot of people out. This is an interesting point. So Peter chimed in and he said, hey, listen, if you don't want to pay taxes, just keep building, which, is kind of true. You want to talk about that a little bit?
Yeah, like I said, because typically when you buy let's say you buy a new laundromat, you buy one and you've got equipment there you're buying, you purchase it, you set it up, you get it running, you're going to get a lot of deduction from depreciation, all the setup costs, you get a lot of expenses along the way. So that first year, like I said, right now there's with bonus depreciation, which is 60%, which you can take 60% of an asset and write it off, or there's other type of deduction called Section 179 depreciation, which may allow you to expense the entire cost of the asset in the first year. So there's a couple of different ways to take that deduction, but what that results in is usually large deductions in the first year, right? Well, okay, I get a large deductions, I have income in that first year. Let's say I have enough deductions to offset my income, I don't pay any tax. Well, next year now comes along year two, I have all this income, my deductions, I've used a lot of those. So now my deductions are lower, now I got some tax consequences I may have to deal with. So what do? I go out and start another laundromat, right? Now, okay, I got the big deductions again, and I get depreciation, I get all that bonus and that stuff again. Oh, and then, okay, come year three, I do it again. And that kind of building your empire by using that, and understand along the way here, I'm paying very little tax because I'm taking all that depreciation deduction. Now, obviously, as you continue to grow in, year 4, 5, 6, that income may be high enough to where you're not getting, by building just one laundromat at a time, you're not getting enough deductions to offset all your income. But again, it will certainly lower the amount of tax you have to pay, which is, like I said, what they're talking about there is kind of building your empire. You get one going, you get figured out, you get the next one in line, and do those year after year. Certainly can be an easy way to reduce your taxes as you're moving along.
Yeah. And, and to Peter's point too, he says depreciate equipment in the building. I mean, if you own the real estate also, I mean, there's even more that you can do when you own the real estate as well. By, the depreciation schedule is a little bit different with real estate than it is, with, equipment, for example. However, also, you can do things like a cost segregation, with real estate, where basically you break everything down and depreciate everything almost individually, at different rates, right? And I mean, I should let you talk about. You want to talk about this?
You're exactly
more?
right, Jordan. You're right in line there, buddy. That's exactly right. So usually, owning the real estate is going to provide some additional tax benefits. Now, it is a commercial real estate building, so as you know, when it comes to depreciation, a commercial building, it's forever. right? It's 39 years. You take the cost of the building. You don't get any deduction for the land, but the building you're going to spread over 39 years. So that's why Jordan brought up that idea of doing what they call a cost segregation, where I take the cost of the building, I'm going to split it up into some of its parts. So I'm going to, so I got pavement outside improvements. I got, I got landscaping. I got window treatments. I got floor coverings. I got, different things that maybe I can take a deduction and depreciate faster than that 39 years. So that will help front load your depreciation a little bit because I'm taking more deductions. But again, that's if I own the real estate and I own that is, the building, the real estate there. Now, obviously, some situations you don't, you lease the building, in which case you deduct your lease payment. But if so certainly there is a whole different side of this if I can own the real estate of the building. Agreed.
Yeah. Yeah. And those two work really well together. I mean, I found that's been my experience, right? The real estate and the business, they work really well together because you got lots of depreciation, you got lots of expenses. And the other thing that we haven't really even mentioned, we haven't even touched on, is that a lot of these things, both real estate and equipment, you can use debt to acquire, right? So not only can you come with a smaller payment, you don't have to have all the cash up front, but I'll put it to you, right? So if I use debt to acquire equipment, for example, can I still depreciate it even though I have debt on it?
Yeah, you're exactly right. If I go out and buy $100,000 of equipment, I can take depreciation on that equipment. Let's say I take bonus, I get 60% of that. That's $60,000 of depreciation that first year. Fabulous. Even though I may have bought it on a contract, I have a loan on it. Maybe the loan's a 5-year loan. Doesn't matter. I can still take the depreciation and take a deduction on the full amount, even though I'm making payments for the next 5 years. Now, be advised, because I'm taking that deduction, the only caveat is you realize you're going to have cash going out in the years 2, 3, 4, and 5 where you don't have deduction because I took the deduction up front. I don't get deduction twice. I only get deduction in the original cost. So, but yeah, that idea of buying equipment on a loan, getting a full deduction for it, which is fabulous now, and still I still don't even have to pay for it yet. I can make payments over the next, how many years the loan is I can get.
Awesome. Thank you for that. Eric has a question, which I think is kind of interesting, actually. So I'm assuming Eric has a laundromat and has social media that is about his laundromat. Is there any kind of interaction between income from online sources, from like a social media account or YouTube or something like that, and laundromat? Is there any kind of write-off potential or anything like that?
No, it's just income. Like I said, you're making money. Obviously, the cost of anything associated with that social media accounts would be deductible. Whether it be your subscriptions or equipment that you're buying to do those. If you're doing podcasts or any of that stuff associated with that, that would be a deduction. But it can be. Oftentimes, I see people split those and maybe do a laundromat LLC and an LLC for my social media just to separate those two businesses. But there's no reason why you couldn't run them in the same. There's no difference. There's no tax advantage to splitting them. Just organizationalized. Sometimes it's easier to have. Okay, I got my laundromat business and I got my social media business, and just running them separate like that. But to be honest, when you file your taxes, all that business income, the net income for both, are netted together and put on the front of your 1040. So there's no advantage to keeping them separate. But certainly there's, like I said, just think about all the stuff, all the expenses related to it. That's what anything related, because remember, a business expense is something that's ordinary and necessary in the course of business. So if you're getting social media income, think about, okay, what are my expenses related to this? Are the things I'm paying for that I think, oh, they're personal, but are they really business deductions that I should be able to get a deduction for, and take the time to, just thinking, okay, what am I actually spending here? What is that for? Is it something that's driving my social media income? If it is, then that would be a deduction. You could take a write-off for that.
Awesome. JR has a great question here. He says, if you're buying a laundromat under a C Corp, can you carry forward the losses from depreciation, et cetera, and use those against future profit?
The answer is yes. If you create what they call a net operating loss, that means you take all your income and all your expenses in a given year, and if those expenses in a C Corp exceed your income, that's what they call a net operating loss. And that loss, whatever that amount, would carry forward into the next year and offset against income the next year. You are correct. It's called a net operating loss. That's fairly common if you have a new business that's starting out. and if you're running it as a C corp, that would be a common thing to have a loss that would carry forward. It can't be. Used to be some rules where you could carry it back. Can't do that anymore. It's only carrying forward.
It's one direction, just
One
like
direction.
life, just like life.
Yeah.
So far, until we invent time travel. Do you know how long you can carry it forward?
I don't off the top of my head. They've changed the rules so many times, but I believe it's 20 years. It's a long time.
Yeah, awesome.
Just by some states, the carryover for losses is different than the federal, so there is difference of ways to handle that. So just make sure you're looking at it. You might have a state loss as well that might be treated differently than the federal loss, because those can be different.
Yeah, and I want to point out just real quick, you can see how this stuff can get really complicated really quickly when you start working in all these different entity structures and, different state laws and federal laws and depreciation schedules and cost segregation, like all this stuff. Right. And, kind of like what Scott said early on, is taxes are your biggest expense that you're going to pay. So this whole, Provision Wealth, where, Scott is, works, and the services they offer, and other CPAs too, and financial, planners. The goal here is to try to structure everything and run everything in the way that optimizes the money that you get to keep, right? And minimizes the money you have to pay for taxes legally, right? And I've been keeping an eye on the chat over there, and there's some other ways to save on taxes with laundromats that I don't advocate, but that is fairly common over there. But listen, this can get very complicated, can feel very overwhelming. If you're sitting there listening and you're like, oh my gosh, I'm like super overwhelmed. Number one is, if you've got a business or businesses that are making good money, don't be overwhelmed. Pay for expertise. That was like an epiphany for me, right? When I realized Scott has decades of, I don't know if decades is really true, but I'm assuming decades of experience doing this. And I can either try to gain my own decades of experience, or I could just pay and buy Scott's experience for this, right? If you're at a point where maybe you have one laundromat and it's not doing tons of business yet, or you're trying to buy your first one, don't be overwhelmed. These are just ideas that you're getting exposed to. This is the world that you're going to move into, even if you're not there yet. And, and then you can pay for the experience of someone else, the expertise of someone else, to help you navigate all of that stuff. So I want to take a second to just say that, because this stuff can get really overwhelming and complex very quickly. I don't understand, like this much of it is all I understand, right? Like, and there's like so much that you can go into, but I just wanted to say, don't get overwhelmed, because if you're already at a point where you're needing help with this stuff and you've got some levels of success, just pay for the expertise. Yeah. If you're not there yet, don't get overwhelmed. Just exposing you to ideas and thoughts about this stuff to get you prepped for when you do get there, and you will get there. Then you can buy the expertise. So I just want to pause and say that.
We talked that sometimes the most expensive words in the English language are do it yourself. Yeah. You know what I mean? So sometimes it's better to say, hey, you know what? I'm going to hire professionals to do this and to help me do this and to get that expertise. Going alone is hard. But getting that expertise, I know when you're just starting out, it's hard to spend money on certain things, but you say, you know what, if I'm going to do this right and I want to make sure I build it for the future, sometimes getting that expertise is the right thing to go.
Yeah. Okay. So, another thing Peter was talking about was buying the business and the real estate separately. So just wanted to kind of touch on that. Are there benefits of buying them separately as opposed to buying them together, having them in one entity versus two, tax wise?
Tax wise, not much of a difference, to be honest with you. But from a liability standpoint, we often see this done, right? Laundromat, you put in the operations in one LLC, the real estate and the building into another LLC, just for liability reasons. So if there was ever a problem at the laundromat from a liability standpoint, like you mentioned, someone slips, falls, tries to sue you, the laundromat, your real estate is protected from that, right? It's separated from that. It's not in the same entity. They couldn't put liens on the real estate. They couldn't do any of that stuff because the operations of the laundromat is in a separate entity. So from a liability standpoint, I probably encourage that. Now, there's no, from a tax standpoint, it's one is, you're obviously, if you have two different entities, then what's happening here? I have a laundromat that then is going to rent the property because they're operating there. They're going to rent it from my own other entity, right? So I'm paying rent to myself, which is kind of nice, and that allows you to take some extra deductions, different fun things there. But the reality is, at the end of the day, the net income from both businesses is what you're going to pay tax on, right? But there is some advantage from a liability standpoint of having them separate. In fact, I usually encourage that just for that liability reason. Most people, where you have an operating business, you own the land and building. And I do it with a lot of professionals. I have a dentist, owns his own building in an LLC. He rents it to himself, to his practice. That's a very common thing you would see, having the real estate side on one LLC and the business in a different. Because the business, I understand, if it's making a lot of money, we talked about, I know in the podcast, about maybe electing to be an S corporation. Well, that would be something you would want to do for the business side. You would never do the real estate in anything that has the word corporation in it. So in that case, you want to have them separate. That gives you the opportunity to make that S election and be an S corporation to save some of the payroll taxes on your business as it grows. So yeah, having them separate is probably a good idea.
Yeah. Yeah. And one point he was making too was, what he tries to do is when you buy them separately, to heavily weight the acquisition cost to the business and to lighter weight, on the real estate, so that so that you can depreciate the equipment more, because the equipment depreciates quicker than commercial real estate, which we talked about, right? So there's a benefit there that depreciation number is going to be higher because you have less runway to actually depreciate it. And then, property taxes on the other side, which, kind of depends on where you're at in there. Now, however, the one thing to kind of consider with this is that if you're dealing with a savvy seller, the seller's not going to want to do that, right? And, because the more that they sell the business for, there's going to be a higher, well, let me defer it to you. Why the seller?
Well, they want the building, obviously, to sell the building, that they avoid any recaptures. Maybe the recapture, they lower the amount on the equipment, so they avoid recapture because they're doing an asset sale.
Yep.
They have, the benefits of maybe doing a 1031 exchange if they're selling the building and the land, that they could sell that abandoned building. You can still do 1031 exchange for real estate, so they may want to do that. And so they want to include more money in the real estate side. So from a seller standpoint, that's where they want to put it. Now, again, from the buyer side, as you mentioned, Jordan, I want to put more of that against the equipment so I can get that depreciation, take that depreciation faster. This is all part of the negotiations, right? This is where you negotiate. Now, like I said, there is a special form that you have to file now with the IRS where both the buyer and seller agree that this is what we're putting into equipment, this is what we're putting into building and land or whatever. You're splitting it out, so we agree, because the old days, the IRS wasn't tracking that, so you'd have sellers treated differently than buyers, and now they've kind of nipped that in the bud a little bit, so you file that form to make sure that the buyer and the seller are treating that, how much is equipment, how much is building, and they're making sure that on the sale that they're treating it the same. So, but yeah, there is different motivations for the seller and the buyer in that case, and that's where negotiation comes in. You say, okay, hey, I understand you want this, but I want this. Can we meet in the middle? Can we compromise? And then that's where the negotiation comes in.
Yep. And that's going to be true no matter what, right? Like there's always that push pull with the seller versus the buyer, in terms of the allocation of the purchase price there. Okay. Waleed has a great question. Let me ask it and turn it over to you. If you own a percentage of a business that's in an LLC, how should you hold those shares in another entity?
Good question. What you're probably talking about there, and I'm not exactly sure, Waleed, but we're talking about what is it called, a holding company, where you would have an LLC that you own 100% of, and that LLC may own portions of other businesses, right? So it may own, 5% in this laundromat, 10% in this one, or 20% in this other business. That's kind of a holding company idea. There's nothing wrong with that. It does give you an extra layer of protection when you look at it from a liability standpoint, to going from just the LLC to you. LLCs usually provide good protection. There are some states where LLC laws have been challenged over the years. They're a little weak. So having maybe a holding company LLC to give you an extra layer of protection would make sense. Understanding that there's no tax benefit for that, though. You're not saving any taxes by doing that. You're creating just an extra liability layer there to give you some protection. So yeah, it's certainly something we see a lot. We see a lot of LLCs. What they would do is they maybe own a business in different states. They would create like a Wyoming LLC or a Nevada LLC, even a Delaware LLC that has some of the best LLC laws in the country. And they create that, and that becomes their holding company LLC that then owns their interest in these different businesses. And that creates a liability barrier there. It does not, like I said, it's not creating any tax savings. It's just a liability protection deal.
Yeah.
But yeah, certainly can do it.
Yeah. And that, I mean, I was going to say that too. So I'm glad you brought that up. You know, if you're going to hold shares of a company in another, like an LLC or something like that, those 3 states that you mentioned tend to have the most favorable things. And also, you know, I know in Wyoming, I think on all 3 of them, but I know at least in Wyoming, all you need is a designated agent in the state there. And that typically is a fairly inexpensive person to hire, and they just
$200 a year.
There. Yeah.
One thing I just want to clarify as I thought through that, well, understanding if you're going to own a business and you want to hold it in your holding company, be advised. Remember in our discussion we had on the podcast, an S corporation can only have individual owners. So if you are an owner, maybe a part owner in an LLC, and that LLC you're thinking about making an S corporation or making an election to an S corporation, you would have to own that personally. You couldn't hold it in the holding company. Just remember, and S corporation owners have to be individuals. Certain types of trust can do it, but so that there is a limitation on that. So if it is a business, you're an owner, and it's maybe an LLC or an S corporation, depending on what type of entity, may determine if you can do that extra layer of protection.
Okay. Waleed wants to delve into a whole different world that opens up a whole nother level of complexity, which I think is great. But again, just don't get overwhelmed out there. If this is like, if you're getting close, this could push you over the edge in terms of feeling overwhelmed. But he says, should that holding be in a trust? And if so, what type of trust? We haven't even delved into the world of trust.
That is a huge. That's a big one.
Massive. Yeah.
Typically, let's just talk general, Waleed, a little bit. Typically, what you'd set up is what they call a living trust. That is a trust that helps you from an estate planning tool. It is not a tax-saving entity. It is not a liability protection entity. It does none of those things. What it does is help you avoid probate often, which is a thing which happens when you die. And your heirs are going to inherit your stuff. Getting all that transferred and title can be a challenge. So typically, some type of living trust would be something you would carry that in. And a living trust is just a name only until you pass away. So it is just what they call a disregarded entity. It is there particularly for estate planning tools, right? That's what its advantage. A living trust is an estate planning tool. It's not a tax saving. It's not a liability protection. It's just for estate planning. Now, mind you, there are hundreds of types of different trusts out there that you can go to attorneys and set something up if you're trying to accomplish some kind of goal. Usually trusts are set up to accomplish some kind of purpose. And so if there's something like a charity or different things you want to do, there could be an advantage to putting some of your ownership in a type of trust that does that. Again, you want to make sure you're very clear on what objectives you're trying to establish, and you're using an attorney or a lawyer that specializes in these trusts that can help you set that up and get you what you're trying to do. I've seen people set up trusts for, with children that maybe have disabilities or things of that nature. There are lots of things you can do, but again, the typical one is just a living trust, which we see the most, which is just an estate plan tool. But there are hundreds of types of trusts that can accomplish different things if you want to do that. So you just got to work with your attorney. What are you trying to accomplish? Would a trust do this that I'm trying to accomplish? And certainly there is an opportunity there if that's where you're trying to go with it.
Yeah, and the world of trust gets really complicated
in a hurry,
really quickly. However, and typically this is something that, I think any business owner should at the very least, dip your toe into the world of trusts, and and thinking through this and meeting with an attorney to help kind of work through some of that stuff, because a lot of this has to do with just wealth transfer, right? And how wealth transfers. So as listen, we're operating under the assumption, because this is what we're here to do, right, that we are going to succeed at this and that we're going to have some level of wealth, some more than others, but that's the goal here. That's the plan. That's why we get into business, to to be able to live the lives that we want to live, and to build wealth and security and prosperity, right? And so it gets complicated though when when somebody who's wealthy dies, unless things are spelled out well, and there's a clear plan in place on where wealth goes after you die and how it gets there. And that's kind of my simplistic understanding of trust, right?
You're exactly right, Jordan. We call it controlling your money from the grave, right?
Yeah.
That's what you're doing. You want to make sure that the last thing you want to do is, if something happens to you, leave a mess to your heirs, your kids, your family, and have them try to work it all out. That's a challenge. I mean, understand that. So a living trust kind of basically just sets all that in order. It gets everything in the right spot. So if something were to happen to you, here are the steps. Here's what needs to happen. And you take all the ambiguity out of it, and it's not a question. Oh, because we've all heard of people, passing away that have money, and the heirs are it's just craziness and complicated, and everybody's trying to figure it out. Well, this type of living trust kind of sets those affairs in order and lets you control things even after if something happens to you. So it just is a huge. If you've been through it, as I've been through it, my parents and my in-laws as well have all passed away, and organization is huge. That makes a difference.
Yeah. And Waleed, real quick, if you're looking to, connect up with somebody who's kind of in that world of trust. And so, I mean, there's tons of lawyers and stuff that can, handle that, but I got some connections. So reach out to me if you are looking to kind of put together a trust. There. I just want to throw this out real quick as we start to wrap this thing up. If you got any last minute questions here, get them in the chat. And thank you everyone for kind of engaging and asking questions. Scott, huge shout out to you. And thank you for answering questions. I'm going to put your provisionwealth.com on the screen here again. Yeah, definitely do that. And I also want to just mention real quick before we wrap up, and I really can't do two things at once. Okay, it's in the chat. I want to just remind everybody, Waleed's event, Laundry CEO Forum, is coming up August 7th through 9th in Frisco, Texas. Make sure you are there. It's the laundry event of the year. I mean, it just is. So huge shout out to Waleed for putting that out. Check out laundryceo.com to get your tickets for that. Because again, it's coming up in a few weeks here. Scott, you are awesome. Thank you so much for coming on the show, sharing so much. Again, where can people find you?
Yeah, provisionwealth.com is our website, and you can get there to a form you can fill out to kind of get interested if you're interested and need help. And then our team will reach out to you and see what we can do to help. I mean, there's, like I said, there's only two things for sure in life: death and taxes. And if we can try to save some of those taxes a little bit along the way, and we really try to pride ourselves in permanent tax savings. We don't do a lot of deferred stuff. I want to save money now. I don't want to ever have to pay it back. I want to be done. I want to save those taxes. And certainly just a small amount. If you think exponentially, if you're save a few $1,000s every year, that's just more money I can put into my business. More money I can grow faster. And the more you can do that, like I said, exponentially your wealth grows faster if you're not having to pay taxes on it. So, like I said, we'd love to help any way we can. As you know, I love taxes. I love talking about it. So I appreciate having me on, Jordan. It's been fun.
Yeah. No, I appreciate you coming on. And listen, wherever you're kind of at on your journey right now, whether you're ready for someone like Scott to come in and help you put together the right plan for you, or you're not quite there yet, the main takeaway here is be proactive about how you're approaching this stuff, right? Whether you have a lot of money or a little bit of money, it doesn't really matter. You want to be as proactive as you can in terms of, setting up your financial well-being and your financial health there. And you can do small things and you can do big things to do that. And the more that you accomplish, the more that you do, the more money that you make, the more businesses that you acquire, the more you need the help of someone like a Scott, who can come in and help you sort it all out and make sure everything's set up and is a well-oiled machine. And then, talk to Waleed after he learns all about trust, and you can get all that situated into, for the next generations.
That's right.
That's right. All right, Scott, appreciate you so much, man. Thanks for coming on. Everybody, thank you for joining in here today. Hopefully you got some good stuff out of that. I know I got a bunch of notes over here. And so we'll see you, at the next Q&A or podcast episode or webinar or wherever we see you guys. So appreciate you guys. Get out there and take some action. Go be proactive. And Peter's threatening the government now. So this is a good time for us to wrap it up. Scott, appreciate you again, man. And we'll talk to you soon.